I'm Julie Hyman here with Akiko Fujita, and we are here at the Future Proof Festival in Huntington Beach, California, where we're hearing from a wide variety of different folks with their opinions on the markets and the financial industry. Among them is David Kelly. He's the Chief Global Strategist at JPMorgan Asset Management. He just got off the stage to my left, where he gave a long and very fascinating presentation about the state of the U.S. economy and markets right now. And so I'm delighted to talk to you following that really interesting presentation. So I would ask, first of all, since we are a couple days out from the Federal Reserve, what you expect the Fed to do. And I will say you seem to have a lot of underlying optimism about the U.S. economy, which I thought was notable as well.
Yeah, so I think the first thing to say is that overall it is basically a healthy economy. I mean, we've seen the unemployment rate is at 4.2%, the inflation rate, the CPI inflation rate 2.5%. You add those two numbers together, 6.7%. That is lower than it's been 84% of the time over the last 50 years. So I think the Federal Reserve really should, they shouldn't have too much angst about this. They should say, look, we're kind of where we wanted to be. The inflation rate has come down. And we always said that we could lower interest rates when inflation came down, even if the economy is doing okay. The economy is doing okay, but we're going to lower interest rates in recognition of the fact that inflation has come lower and it's not appropriate to have high interest rates anymore.
Julie cited the optimism in your presentation, even more so given the panelists that were on stage before you came on, saying that, look, we are going to see a slower growth economy right now moving forward. The time for the Fed to essentially flip the switch has now passed. How do you view it in that sense? It feels like the market has really been caught up on how significant or how many more of those cuts are likely to be. It sounded like you were saying, well, the economy is going to be okay regardless.
Yeah, so I do think that the Federal Reserve, first of all, I don't think they should have pushed rates as high as they did. And I do think they should have started cutting slowly early on. I've always believed that. I think that they are too active in how they try to talk about or how they try to manipulate the economy. Having said that, though, they're not. If they cut rates aggressively here, they're going to undermine confidence, and that's the whole point about cutting rates. Cutting interest rates from a height, it's kind of like lowering a piano down from the fourth floor of a building. You got to do it slowly and carefully, because the biggest risk is that you freak people out. The biggest risk is people say, "Oh, I wonder why they're cutting rates so much. Maybe they're scared of recession, and so I'm now going to postpone the hiring I was going to do. I'm going to postpone buying the business I was going to do. I'm going to postpone taking out a mortgage because I think they're going to surely cut rates more." And that actually slows the economy. Eventually, when rates get low rates can stimulate the economy. The first few moves actually hurt the economy, not help it. That's why the Federal Reserve has such a hard time cutting rates and actually having it help the economy, because it actually hurts before it helps.
So David, is that the biggest risk to the U.S. economy right now? Is that the Fed will not do this smoothly, do too much, or is there another risk that you're paying attention to?
I think it's the biggest known risk, but I will say that the history of the 21st century is really one of a lot of things you didn't expect actually happening. I mean, so we've seen, obviously 9/11 was terrible, and you had the great, when Lehman Brothers went under, and when you had the pandemic recession. These sort of shocks are really the sort of thing that actually make recessions. I think if the Fed gets it wrong, we'll have even slower growth for a while. I think people will worry about recession, but in the end, you've got to give me a reason why consumers stop spending. And I think it takes a lot to make American consumers stop spending.
Adding to Julie's question about additional risks here, we are less than 2 months out from the presidential election. Not so much the question about what's the risk and who gets elected, so much as that it just doesn't feel like the question about rising debt is necessarily being addressed in the conversation. You had a slide up there talking about those very risks. What worries you most when you look at the plans that have been presented by both candidates?
Well, I do. There are things that worry me. I think the thing that doesn't worry me is the debt itself. We absolutely need to deal with it, but what we've seen is the world has got a tremendous appetite for U.S. debt. Last year, the Treasury Department managed to raise $2.7 trillion of additional debt, and long-term interest rates didn't even go up. And so if they can do that, I think we can actually handle big deficits for a while. One of the things that worries me is if we got into a trade war. Both sides have embraced tariffs, obviously one side more than another, but tariffs are terrible economic policy. They are a magical stagflation elixir. There are very few things that can actually cause the economy to slow and push up inflation at the same time. And tariffs can do that. So if we had aggressive tariff policy to try to finance the deficit, that would put us into recession.
I mean, couldn't you argue that tariff war never ended, though? When you consider that the tariffs from the Trump administration have remained in place, specifically on China, you look at what Europe is doing, for example. They are following the same playbook as well. Is that where, what does that mean in terms of global growth if you're seeing the U.S., Europe, and others following?
Yeah, so I think we did move backwards from globalization in the last few years. I think we obviously have seen some tariffs which have stayed in place, but the economy has now sort of adjusted to that. I don't think the economy has grown as fast as it would have done without that. But I certainly don't want to see a big escalation of this because, if we have a massive increase in tariffs like 10% or 20% on all imported goods, that will massively increase inflation. But it also slows trade because, the idea that it's almost like a 2-year-old's mentality. I can punch somebody on the nose and then you're shocked that they punch you back. Of course they're going to punch you back. And so what will happen is it'll kill our exporters too. So you manage to cause inflation and kill exports at the same time. That's why it's so dangerous. And I wish that neither party would talk about tariffs at all.
David, I want to bring it back to the markets and strategy here for a moment. You were talking about the 60-40 portfolio, which has been a big topic of conversation here, by the way, at this event. And if I read the slide that you were showing correctly, it seems like because of the outperformance of that portfolio over the past decade, it's not as likely to do as well over the decade from here. Yeah. So what should people do?
Well, I think it reminds me a little bit of a situation in 2000 where after a massive run up in equities and the bond market was looking pretty good, if you look at returns in a 60-40 portfolio over that decade, they're pretty crummy. And of course you could talk about individual sell-offs in markets, but the big problem is you started off with overvaluation. And so yes, I think that returns from 60-40 will be less great going forward. But again, if you take this long-term logic, you have to have the discipline to add international to a portfolio because we do think that in the long run that will give you better returns. And also look at alternatives. Things like infrastructure, transportation, some areas of real estate if you can find the right manager.
Well, that's a good, alts have been also a huge topic of conversation here. Alts meaning alternative investments. Do most people have access to that in enough size?
I think that's growing. I think a lot of firms, including our own, are trying to make alts more accessible. And part of that is actually producing vehicles like evergreen private equity funds so you can get in and get a full private equity exposure immediately and get out when you want, with some limitations. And then also the other half of it's education. We produce a guide to alts, guide to alternatives, and our goal is to try to clarify what's actually going on in these sectors, because I think the industry is full of jargon, it's full of confusion. We really want to work through these, make it easier for individuals. When we talk about accessible, it's got to be financially accessible, but it's also got to be mentally accessible, and we want to make alts clear to people.
Well, I thought your presentation that you did was very accessible, clear, made some great points. Thank you so much for joining us, David. Appreciate it.
You're very welcome.
Thank you.
Thank you.
It's David Kelly of JPMorgan Asset Management.